thinking about the person listening and or watching this podcast episode and is a DIY investor or somebody that is working with a financial advisor, giving this group of people some action items. What questions do
Yeah.
people need to be asking, and what action items do people need to be taking right now?
Number one, you need to understand how you're invested. If you're not a client, then we can run that complimentary report through Morningstar, through Riskalyze. It's a black and white report. So it's going to tell you got 78% in stock, 15% in bond, 5% in cash. We can produce that report by having someone's statements and by having the positions that somebody's in, and the report doesn't lie. That's when you can truly understand, all right, here are the pros, here are the cons of how I'm currently invested. And typically it needs to be tweaked somewhat. I mean, usually, oftentimes, people are coming in as potential clients taking on too much risk.
Okay.
It's a big reason why people are coming in realizing, hey, I haven't tweaked this thing. I've been running with it for years. And man, thank God the market's been up. But I need to make sure that this thing is in check, that this thing is buttoned up as much as possible. You need to know how you're allocated, stocks, bonds, whatever it is. That's going to help you determine how much risk you're taking. It's a geeky term called standard deviation, and you got to go back to 8th grade to remember what standard deviation is. If you can remember that far back, maybe college statistics class. And it's basically the biggest measure of investment risk. And the bigger your standard deviation number, the bigger the risk is in your portfolio, the wider the potential swings and volatility could be in your portfolio. You need to understand how you're allocated. Risk, the cost. What do the funds cost you in your portfolio? If you're in mutual funds and funds that you bought 10, 15, 20 years ago, there's a really good chance you're paying more than you should be. And fund costs are like termites and can eat into the net return of your portfolio long term.
Okay.
So we'll use low cost, passive ETFs, stocks, and typically instruments on the market side of our portfolio that are extremely low cost, as an example, like a Vanguard ETF. Those are some of the main things that I would look out for if I was approaching retirement, whether you're working with an advisor or not. And if you're not, how would you know?